to saying the data will be credible.
The idea that somebody might lose their job because of a bad number is a very, very poor way to
the data from the Bureau of Labor Statistics has deteriorated in quality and reliability over the decades.
Something unusual is unfolding across America's job market. More than 25 states are now watching unemployment quietly edge higher, marking the most widespread rise since 2020. The national rate has climbed from 3.4% to 4.3%, wiping out paychecks for millions in only a few months. Yet Washington continues to insist that the economy remains stable. Meanwhile, consumer debt has surged past $1.14 trillion. Wages have stalled, and job openings are disappearing at a pace not seen since the Great Recession. Economists are calling this a soft landing, but if that's true, why are so many Americans slipping through the cracks? Because this isn't a slowdown. It's a quiet collapse that's now beginning to show everywhere. The fractures are spreading. Across the nation, job boards that once overflowed with listings now sit nearly empty. More than 8.2 million Americans are officially unemployed, yet that figure tells only half the story. Another 5.4 million people have stopped even trying to find work. The government calls them discouraged workers, as if changing the label could erase their struggle. These aren't just numbers, they're individuals sending out hundreds of applications without a single full-time paycheck in return. In states such as Ohio, Nevada, and Michigan, layoffs in manufacturing and logistics have jumped by over 27% since early 2024. Meanwhile, major retailers are quietly cutting employee hours to dodge benefit costs. A warehouse worker who once earned $22 an hour now juggles two part-time jobs at $15 each. No health insurance, no overtime, no stability. The illusion of low unemployment hides a harsh truth: a workforce running on exhaustion. Behind every percentage point lies the slow breakdown of security. Companies are replacing people with machines, trimming billions through automation, nearly $30 billion in labor cuts every year. Corporate reports boast of record productivity, yet workers see none of the reward. Real wages, adjusted for inflation, have fallen 2.3% compared to last year. Everyday costs tell the rest of the story. Food prices are up 19% since 2021, and the average rent now exceeds $2,100 a month. For millions of Americans, every grocery run feels like a test of survival. What makes this decline so eerie is its calmness. There's no market crash, no panic headlines, just a slow squeeze. People are still working, but living worse. Businesses are still hiring, but paying less. The middle class isn't collapsing overnight. It's slowly fading away. One reduced shift, one rent hike, one lost benefit at a time. America's job market isn't falling. It's bleeding in silence, hidden behind cheerful reports and delayed statistics. The economy isn't shrinking. The American dream is. And as the gap between official numbers and lived reality widens, the warning signs grow louder. According to the National Bureau of Economic Research, one of the earliest indicators of recession is a steady rise in unemployment. And by that measure, history is already repeating itself. Since the 1960s, every time joblessness has climbed by more than 0.8%, a recession has followed. That exact pattern is now emerging again. Yet policymakers continue to project calm. The nation still reports 2.1% GDP growth, steady industrial production, and positive corporate earnings, at least on paper. But beneath that calm surface, the real economy is cracking. Factory orders have dropped 4.6% in the last quarter, small business optimism has plunged to its lowest level since 2010. And new housing construction is down 17% year over year. Even the University of Michigan's Consumer Sentiment Index, a long-trusted gauge of household confidence, now sits near levels last seen during the 2008 financial crisis. These aren't just statistics. They're contradictions turned into policy. The government continues to measure growth while ignoring what that growth actually represents. GDP can rise even as daily life declines when expansion is fueled by debt instead of production. And that's exactly what's unfolding now. The national debt has surpassed $38 trillion, increasing by $1 trillion every 100 days, the fastest pace in U.S. history. What looks like progress is, in truth, borrowing disguised as prosperity. The danger of this hidden downturn lies in its silence. There's no dramatic market crash, no wave of panic, only a slow distortion of normalcy. The system still moves, but without direction. This isn't the rhythm of a healthy economy. It's the fatigue of a structure running on momentum alone. Jobs are fading, prices are climbing, and productivity gains are built on borrowed time. The data doesn't lie. The interpretation does. That's why this crisis feels invisible. The numbers may look stable, but they're measured in dollars, not in human lives. What's truly unraveling isn't the economy itself, but the foundation that holds it together. This quiet breakdown in the U.S. is no longer isolated. The same tremors are now echoing across other developed nations, forming a synchronized pattern of decline that economists hesitate to label a crisis. In Canada, unemployment has surged to 7.1%, the highest since 2016. Germany now sits at 6.3%, while the UK faces 4.7% unemployment alongside staggering household debt of $280 billion. These aren't random fluctuations. They're signs of a global labor contraction driven by automation, corporate downsizing, and falling consumer demand. For the first time in modern history, nearly all major Western economies are tightening at once, while their populations see living standards erode. The combined GDP growth of the G7 has fallen below 1.2%, the weakest level since 2009. Industrial output in Europe has dropped 3.4% this quarter, and North American exports are shrinking despite supposedly strong markets. Every economic heartbeat is slowing, yet central banks continue to project control through interest rate tweaks and reassuring statements that sound more like therapy than policy. Beneath the surface of every chart lies the same unsettling reality. Productivity is stalling while debt explodes. In Japan, public debt now exceeds 60% of GDP, and in France, social spending consumes over 31% of national output, the highest in the developed world. The Western system, once designed to expand, is now trapped in maintenance mode. Growth is no longer the priority, survival is. The uniformity of this slowdown points to an uncomfortable truth. The global economy has become fragile in unison. Traditional safeguards like geographic distance, diverse industries, and independent monetary policies no longer protect nations. When one market falters, the others follow immediately. The collapse isn't confined to a single area. It's emerging everywhere, slowly and simultaneously. And as these cracks widen worldwide, the illusion of recovery at home grows harder to defend. The pressing question is no longer whether the system will fail, it's which domino will fall first. Meanwhile, global financial markets are sending a very different signal. Stock indexes are hitting record highs, optimism abounds, and confidence seems unshakable. Yet beneath these green numbers lies a stark paradox. The market thrives because the real economy is breaking. In early 2025, the average stock fell 35% during a brief downturn, only to rebound within months, not due to real growth, but because expectations fueled the recovery. Trillions of dollars of speculative capital now circulate in markets detached from labor, production, or real value. While the U.S. stock market has gained over $11 trillion in capitalization since mid-2024, total worker compensation has barely moved, rising just 1.3% after inflation. Corporations are laying off staff while simultaneously pumping billions into share buybacks, nearly $1.1 trillion in 2025 alone, the second largest figure ever recorded. Wall Street celebrates efficiency, but Main Street bears the cost. The economy has become a reflection of concentrated wealth rather than shared prosperity. This growing imbalance creates a dangerous illusion. Investors interpret rising markets as a sign of a healthy economy, but it's a mirage sustained by liquidity, not fundamentals. Corporate earnings growth has slowed to just 0.6%, while household purchasing power steadily declines. The strength of the market reflects monetary support, not real productivity. When optimism replaces production as the engine of growth, collapse becomes a matter of timing, not possibility. The emotional impact is profound. A society where stock prices soar while savings and wages stagnate is on the edge of psychological fracture. People see record market valuations, yet experience unprecedented insecurity. Confidence indexes rise because algorithms trade optimism faster than humans can feel despair. This fragile illusion will last only until liquidity dries up or a policy misstep snaps the delicate thread. And when it does, the very same cycle that fueled hope will magnify the collapse. At the center of this fragile balance sits the Federal Reserve. Every decision it makes now carries enormous weight. Since mid-2024, the Fed has quietly reduced rates from 5.5% to 4.25%, signaling cautious easing. But unlike past crises, this isn't an emergency rescue. It's controlled restraint. The Fed is trying to calm inflation without triggering a collapse, a task no modern central bank has managed for long. Inflation still hovers around 3.6%, well above the 2% target. Shelter costs climbed 6.2%. Energy prices rebounded 9%, and core food prices remain 18% higher than pre-pandemic levels. In a normal recovery, lower rates would spark hiring and lending. Instead, banks sit on over $3.4 trillion in cash reserves, hesitant to lend in an uncertain environment. The Fed's calm is not confidence, it's paralysis. Each reduction in rates inflates asset prices while the real economy struggles for liquidity. Every official signal insists that the U.S. is on a soft landing, yet the data points tell a far more troubling story. Corporate defaults are up 41% year over year. Commercial real estate loans worth $1.1 trillion are approaching maturity, and Treasury interest payments have surpassed $1 trillion annually for the first time in history. The central bank is trapped. Raise rates and risk mass defaults, or cut further and risk reigniting inflation. The result is a stalemate unlike anything seen before. Monetary policy has lost the ability to stabilize the system. What appears as calm is actually exhaustion disguised as stability. The longer this delicate balance is maintained, the more violent the correction will be when it finally breaks. Beneath the surface of GDP growth and measured inflation lies the most dangerous shift yet: the erosion of financial resilience across households, corporations, and the government itself. America's household balance sheets, once the backbone of economic strength, are now rapidly deteriorating. Consumer debt has surged past $17.6 trillion, with credit card balances alone topping $1.14 trillion, the highest ever recorded. Interest rates on these cards exceed 24%, trapping millions in compounding debt. The average American now spends 46% of their income just covering rent, loans, and utilities, leaving almost nothing for savings or mobility. Personal savings have collapsed to 3.4%, the lowest since 2005. Over 60% of households report they couldn't handle a $400 emergency without borrowing. What the financial system calls resilience is, in reality, slow suffocation. The erosion of household stability mirrors corporate stress. U.S. companies now owe $13.7 trillion in debt, much of it borrowed at near-zero rates. As these loans come due under higher interest, profit margins risk being wiped out overnight. The commercial real estate sector alone faces over $2.2 trillion in debt resets through 2027, threatening a cascade of defaults that could ripple across pension funds and regional banks. This isn't the chaos of a sudden crash. It's the slow exhaustion of capacity. Every institution, from households to corporations to government, is running out of margin for error. There's no buffer left between normal operations and collapse. The frightening part is how quiet it all feels. Metrics appear orderly, but the structure beneath is hollow. The economy hasn't failed outright. It has thinned to a fragile shell. The next shock, whether financial, political, or environmental, won't need to destroy the system. It will only need to touch it. In that instant, the entire illusion could shatter. What follows financial exhaustion is psychological collapse. Economies don't break the moment money runs out. They fracture when confidence disappears. Across the United States, public trust is evaporating at its fastest pace since 2008. The University of Michigan Consumer Sentiment Index has plunged to 61, a level typically seen only in deep recessions, yet GDP still reports growth. This contradiction is emotional, not statistical. People no longer believe in the recovery narrative, and that disbelief is visible everywhere. Two-thirds of workers fear losing their jobs within the next year, while over 58% report that their income hasn't kept pace with inflation for 3 straight years. The result is an invisible depression, not in markets, but in morale. American workers aren't striking or protesting. They are quietly disengaging, surrendering to a system that no longer serves them. Every collapse begins quietly, then unfolds all at once. The American economy now teeters on that silent edge, where numbers still appear stable, but underlying momentum has stalled. The yield curve has remained inverted for over 16 months, the longest stretch since the early 1980s, a warning that has preceded every modern U.S. recession. Corporate bankruptcies have surged 58% year over year, and regional banks report delinquency levels unseen since 2012. Yet policymakers describe this precarious moment as resilience. The language of reassurance masks the growing pressure points: commercial real estate debt exceeding $900 billion, auto loan defaults up 42%, and credit card delinquencies at 7.8%, the highest in more than a decade. Behind each statistic lies the same truth: the margin of stability is gone. The Federal Reserve cannot tighten without triggering systemic stress, nor can it ease too fast without reigniting inflation. Treasury borrowing is straining confidence, and corporations cannot refinance without taking massive losses. Every lever of control now deepens the imbalance. Institutions celebrate growth while quietly preparing for contraction. What comes next won't be a sudden crash in stock prices, it will be a collapse of faith. The world's largest economy isn't growing. It's stalling in slow motion, one fragile illusion away from complete breakdown. And when that illusion finally shatters, it won't just crush markets, it will shatter trust itself.